Welcome back to The Deep Dive. We're TalkTickers, getting you informed fast.
And today we're jumping into a recent earnings call. A major footwear player.
Yeah, you probably know them. They just reported their first quarter for fiscal 2025. It's definitely a challenging time for retail out there.
For sure. But this story isn't just the raw numbers.
Right. They actually beat profit expectations, which caught some attention. And maybe more importantly, they've really hit the accelerator on their big strategic plan.
Exactly. So think of this as us guiding you through what really matters from that call. We've listened, read the transcript, and there's a definite narrative.
Okay, let's start with that performance snapshot then, Q1 headlines.
All right, so first quarter fiscal 25, net sales came in at $277.7 million.
Okay.
Now, right away, that's a drop from last year's $300.4 million, so down about 7.5% year over year.
And comparable store sales, how did they look?
Also down 8.1%. They did mention, though, that about 1% of that was because stores were temporarily shut for these transformations they're doing. That's a key piece here.
Right, the transformations. We'll get to that. So sales down, which honestly isn't a huge shock in this environment, but you mentioned the profit side was different.
Yeah, that's the interesting part. Reported net income was $9.3 million. That's 34 cents per diluted share.
Which is also down from last year, right? I think last year was more like $17 million.
Correct. $17.3 million or 63 cents a share last year. So profit is down year over year. But, and this is the crucial bit, Navi, those Q1 profits actually beat market expectations.
Ah, okay. By how much?
By roughly 10%, they said.
So, okay. Sales headwinds are real, profits lower than last year, but they managed things well enough to beat the street. Why the drop from last year then, specifically?
They were pretty upfront about it. It's mainly planned investments. They're pouring money into this big strategic transformation initiative.
Okay.
And, you layer on those general industry headwinds hitting sales, and that puts pressure on the bottom line.
Got it. Investing for the future, battling the present, but executing better than expected. Let's dig into that transformation. What's the core idea?
The singular focus, they stated, is becoming the nation's leading footwear retailer for families. That's the mission.
And the vehicle for that is?
Their Shoe Station banner. That's the centerpiece. The whole strategy revolves around it.
Shoe Station, right. That's their more premium format, isn't it? Higher-end brands, nicer stores.
Exactly. They described it as their premium banner, designed to pull in higher-income households. Think top brands, more service, a really welcoming store environment.
So the bet is that this format, this customer, is maybe a bit more resilient right now.
That seems to be the idea. Attract the shopper who values brands and experience, maybe less price sensitive than some others.
Does the data back that up? How is Shoe Station performing compared to their traditional stores or even the rest of the industry?
This is where it gets really interesting. They said, look, the overall family footwear market in our own traditional stores saw comps down in the high single digits this quarter.
Okay, so consistent declines there.
But Shoe Station, it posted industry-leading sales growth of 4.9%. And it was actually compositive.
Wait, positive growth when everyone else is down like 8-9%?
Positive 4.9% comparable store sales growth for Shoe Station. It's a huge difference.
Wow, okay. That's stark. Is this a one-off or a pattern?
Definitely a pattern. They emphasize this. Shoe Station has been consistently, sharply outperforming their other banner and the industry average for over 2 years now.
2 years.
Yeah. And get this, they said Shoe Station stores are generating over 20% better sales compared to their traditional stores. That's averaged over the last 5 quarters since they started converting stores.
20% higher sales per store. Okay, you can't ignore numbers like that. That has to be why they're accelerating the plan so much.
Precisely. Seeing that consistent, strong performance, they're basically putting their foot on the gas. The new target is for Shoe Station to be over 80% of their total store fleet by March 2027.
Over 80%. What was the old target?
It was 51%, so a massive jump in ambition. And they expect to hit that original 51% mark much faster by July 2026.
Okay, 80% by 2027. That's really moving. How many stores does that translate to near term, like end of this fiscal year?
Well, they started the year with 42 Shoe Station stores, about 10% of the fleet. They just finished Q1 with 70 stores, that's 16%, after converting 24 in the quarter.
24 conversions in 1 quarter. Okay.
And the plan is to end this fiscal year, fiscal 2025, with around 120 Shoe Station stores. So roughly 28% of the total fleet by year end.
So a big ramp up this year.
Huge. And because it's becoming so significant, they also mentioned they'll start breaking out Shoe Station banner sales growth, specifically in their reports going forward.
Good. More transparency there. Did they share any real world stories from the conversions they did in Q1, specific learnings?
They did, and this was really insightful. They talked about 4 specific store conversions from Q1, all different types of markets.
Okay, let me hear these. What did they find out?
First, they took an underperforming traditional store. It was in Florida, kind of an affluent, older demographic, beachy area. The kind of place you'd think Shoe Station would work well.
Right, seems like a natural fit.
And it was. They flipped it. Sales jumped over 20%. Average unit retail, the average shoe price went up nicely. Margins improved, what they call accretive margins. They called it a home run. Validated expansion in similar markets.
Okay, makes sense. Checkbox 1, what about somewhere less obvious?
Example number 2, an average performing store, but this one was in rural Tennessee, over an hour from a major city. Demographics didn't scream premium,
Right.
but they looked at the local competition, saw a gap for Shoe Station's merchandise mix. They converted it, and boom, sales up over 20% again, higher AUR, better margins.
Really? In rural Tennessee?
Yeah, they proved their analysis right. Shoe Station could fill a niche even there.
So affluent coasts and underserved rural spots. Interesting. What else?
Third example doubled down on rural. A similar conversion in rural Alabama showed even stronger results than Tennessee. So they're feeling really confident about taking Shoe Station into rural America now, whether the brand is known there yet or not.
Okay, affluent, rural. Did they try it in, say, lower income areas or more diverse markets?
This was the one they called a potential game changer. They took a store that was doing poorly. It was in Georgia, lower income area, highly diverse population, but not in a major city center.
And they were nervous about this one?
They admitted they weren't sure how it would go, maybe flat, maybe even slightly down was the internal expectation for a premium banner there. But they were surprised.
How so?
The customers responded really strongly, just as strongly as in the affluent Florida or rural Tennessee examples. They loved the new assortment.
Wow. Okay, that is a surprise. Why is that a game changer?
Because if Shoe Station works well not just for higher income folks or in rural white space, but also resonates strongly with lower income diverse customers, well, that massively expands the potential footprint.
Right. It means way more of their existing stores could potentially be successful conversions.
Exactly. So the immediate plan is, okay, let's quickly convert a few more stores just like that Georgia one and see if we get the same great results consistently.
So the big picture from these examples, Shoe Station seems to turn average, even poor, traditional stores into growth engines. And it works across a much wider range of places than maybe they first thought.
That's the key learning. Affluent, rural, diverse, lower income. It seems to be clicking. And they tied it back to the financials. This re-banner strategy delivers that outsized growth and better product margins.
And the investment pays off quickly.
They said the P&L investment has a compelling 2 to 3 year payback. Based on that, converting stores to Shoe Station is hands down the best use of their capital right now.
Makes sense. Fast payback justifies the acceleration. How are they funding all this? Is the balance sheet strong enough?
They made a big point of this. Strong financials are a key advantage. They have zero debt.
Zero debt. Nice.
And not just debt-free, their cash position has actually grown. They ended Q1 with $93 million in cash and equivalents and marketable securities. That's up over 30%, about $23.5 million more than last year. Plus, they have nearly $100 million available on their credit line.
Okay, debt-free, plenty of cash, access to more. That gives them serious flexibility, especially now.
Absolutely. They see it as letting them make opportunistic moves, maybe grab some margin opportunities. And critically, they can afford to invest heavily in the rebanners and inventory for the long haul, while some competitors, maybe more leveraged, might have to pull back.
They said their balance sheet is stronger than a year or two ago.
Yep, explicitly stronger.
How does that strength play into inventory? Are they being cautious, holding back?
Quite the opposite, actually. They deliberately increased inventory levels up 4% versus last year.
Oh, interesting. Why?
Leveraging the strong balance sheet. They want to navigate uncertainty, potential supply issues. They bought early for key seasons like back to school and holiday to make sure they have the product.
Smart. Get ahead of potential problems.
And they mentioned they secured that inventory at good costs, which should help protect margins, maybe even boost them later. It positions them well if supply chains get messy again.
Using financial strength as an operational weapon. Did they mention any product areas doing particularly well, especially in Shoe Station?
They did call out men's and women's performance running. said it continues to deliver exceptional results, particularly strong double-digit growth for those brands within Shoe Station.
And good price points, too.
Yeah, robust AURs, averaging over $130 for those running shoes.
Nice. What about overall merchandise margin for the quarter? Did it hold up?
It actually improved, up 50 basis points, 0.5%. They said this reflects their focus on profitable sales, not just chasing volume, and they directly credited the higher margin Shoe Station stores for part of that lift.
Okay, so the model works financially too. What about the costs? All of these conversions must hit SG&A, right?
Yes, selling general and administrative costs. In dollar terms, they were down slightly, which is good. But as a percentage of sales, SG&A went up 30.2% this year versus 28.1% last year.
And that increases purely the transformation costs.
Primarily, yes. They listed things like temporary store closing costs during the conversion, amortizing the new build-out costs, marketing to acquire customers for the new format. The sales hit while the stores closed for 4 to 6 weeks, writing off old assets. It all adds up.
Okay, so that's the expected short-term pain for the long-term gain. Did they put a number on the total financial hit from these investments for the full year?
They stuck to their previous estimates. Capital spending for the 75 conversions planned this year should be $30 to $40 million. About $10 million of that was spent in Q1.
And the impact on the profit and loss statement? The earnings hit.
The P&L investment for the full year is expected to be $20 to $25 million. That covers the amortization, opening costs, marketing, lost sales during closure, etc. They figured this total P&L impact will reduce operating income this year, fiscal 25 versus 24, by about 65 cents per share.
65 cents per share drag. That's significant, but again, ties back to that 2-3 year payback plan.
Exactly. And the Q1 impact was about $5.5 million pre-tax, or 15 cents a share, right in line with what they planned for.
Okay. And just to hammer the point home, how did Shoe Station perform within specific product categories? Was it strong across the board?
It really was, and the comparisons are striking. Let's quickly run through the big ones.
Yeah, let's hear it.
Athletic. Biggest category, 46% of sales. Down mid-singles overall. But Shoe Station Athletic grew low teens.
Huge swing.
Women's non-athletic.
Okay.
24% of sales. This was hit hardest by cautious consumers, down mid-teens overall. But Shoe Station did much better, especially in dress shoes. The decline rate in their traditional stores was almost double Shoe Station's decline rate.
Wow. Okay.
Men's non-athletic, only 7% of sales, down low singles overall. But Shoe Station was actually composite of low singles here. Better brands, higher prices working.
Composite again.
Children's, 18% of sales. This was tough. Low teens decline overall, particularly with lower income shoppers pulling back. The Shoe Station kids, only down low singles. Massively outperformed the average.
Okay, so it really doesn't matter. The category athletic, casual, men's, women's, kids, Shoe Station just performs way better than the traditional stores right now.
That's the clear pattern. It really boosts their confidence that this Shoe Station format is the right engine for future growth, regardless of category headwinds. It seems to mitigate those broader challenges somehow.
Or maybe just attracts a customer less affected by them, or one wanting to pay for the difference. So looking ahead, what's the official outlook for the rest of this year?
They reaffirmed the full year guidance ranges for fiscal 2025.
Give us the key numbers.
Okay. Net sales. $1.15 billion to $1.23 billion. That's a range from down 4% to up 2% versus last year.
Big range.
It is. GAAP EPS, $1.60 to $2.10. Gross profit margins, 35% to 36%. SG&A costs, $350 million to $360 million. And total CapEx, $45 million to $60 million with that $30-40 million chunk for the rebanners.
Given that wide sales range, where do they actually expect to land, and what gets them there?
They're hoping for sales declines to moderate as the year goes on, maybe even turn slightly positive towards the end. The drivers. More Shoe Station stores opening and contributing, strong product for back to school and holiday, and maybe some help from easing trade cost pressures later on.
So the growing Shoe Station base starts to counteract the traditional store drag more significantly.
That's the idea. As Shoe Station gains scale, its strength should increasingly offset the industry weakness hitting the older format stores.
And when do they think the whole company gets back to positive comparable store sales?
With this faster conversion plan, they're now targeting Q3 of fiscal 2026. That's about a year and a half out. By then, they expect Shoe Station will be big enough to pull the total company into positive comp territory, even assuming that traditional stores remain challenged.
Okay, Q3 26 for positive comps. What's the biggest risk or unknown in getting there?
Consumer sentiment. That's the big question mark, especially for back to school. They mentioned seeing a segment of their traditional store customer pulling back, worried about prices, maybe influenced by negative news cycles.
Yeah, consumer mood is definitely the wild card everywhere. What about external factors like tariffs and supply chains? Still a concern.
They addressed it. Said so far, to date, they haven't seen any huge product cost spikes beyond what they factored into their guidance, even with things like the higher China tariffs or talk of a new universal tariff.
And why do they feel somewhat insulated?
Two things, mainly. One, being primarily a retailer gives them more control than, say, a wholesaler. Two, and more importantly, that strategy of using their strong balance sheet to buy inventory early at good prices. They think that gives them an edge over competitors who might be facing cost increases more directly right now.
So proactive inventory management is a buffer.
Seems to be. They admitted it's fluid, things could change, but nothing's really surprised them negatively yet compared to their plan.
Okay, managing risks, looking way out. Are they thinking Shoe Station could eventually be everything, 100%?
They said they're deeply evaluating exactly that. Could Shoe Station be the only banner in the future?
How will they figure that out?
They're planning specific market tests during 2026. Crucially, they want to convert some stores in major urban centers. They threw out names like Chicago or Houston, probably by early 2026.
Ah, the urban test. Why is that so important?
Because it's a different customer base than they've proven success with so far. Can Shoe Station meet the needs of lower-income, highly diverse populations in big cities? If yes, that really unlocks the potential for near 100% conversion. If not, maybe they need to keep some traditional stores or develop something else.
And if it does work in cities, what's the benefit of going all in on one banner?
Big potential for internal efficiencies. Streamlining operations, marketing, inventory, simplifying the business could save money and complexity. Even on the current faster plan, they expect the traditional store count to be under 100 by March 2027 anyway.
Makes sense. Any mention of M&A acquisitions?
Briefly, they said they remain committed to looking for large, scale-changing M&A if the right deal at the right price comes along, leveraging that strong balance sheet again. So organic growth via Shoe Station is priority one, but they're keeping their eyes open for deals too.
Okay, so a clear organic strategy with Shoe Station at the core, actively testing its limits, and M&A as a potential accelerant. Very focused. All right, let's shift gears. As TalkTickers, we like to play with the what-ifs based only on what we heard in the call. Standard disclaimer, this is absolutely not financial advice, just thinking aloud.
Right, purely hypothetical discussion based on the call's data points. No recommendations here.
So here's the thought that struck me. All those examples of Shoe Station working surprisingly well. Affluent Florida, yes, but also rural Tennessee, rural Alabama, and especially that game-changer, lower-income, diverse Georgia store.
Yeah, that unexpected breadth of success was a major theme.
Exactly. So the outrageous but plausible idea, what if you took a long position betting that this rapid Shoe Station expansion into all these newly validated diverse markets drives growth much faster and higher than the company's own guidance or what the market expects?
Okay, unpack the plausible part based on the call.
Plausible because management isn't just hoping they're actively accelerating the rollout because of these strong results they're seeing right now in these varied markets. If those early successes aren't flukes, if they scale, it means a huge chunk of their existing stores can be profitably converted much faster than if Shoe Station only worked in predictable upscale suburbs.
Right. The acceleration is driven by data they already have.
Plus, you add in the debt-free balance sheet, giving them firepower, and the smart inventory moves potentially protecting margins. It creates a scenario where they could significantly outperform that wide, maybe cautious guidance range.
Okay, they definitely have the financial means and operational strategy aligned to push hard.
Now, why is it outrageous? Because it flies in the face of the gloomy retail outlook and management's own caution about maybe hitting the lower end of guidance due to consumer worries impacting the traditional stores, which are still the majority today.
True, the macro environment is the big cloud hanging over everything.
And this idea assumes those early home run results in diverse spots are instantly and consistently scalable across dozens, eventually hundreds of stores. That's a big leap based on really a handful of data points so far, even if they are compelling.
The market is likely weighing that broader consumer risk heavily.
For sure. But the plausible kicker is the speed and surprising breadth of Shoe Station's success, potentially overwhelming those headwinds faster than expected. It's a bet on execution and the power of the specific format, based directly on the call's evidence.
Understood. Hypothetical trade idea grounded in the call's details.
Precisely. So let's wrap this deep dive. What are the absolute key takeaways listeners should remember?
Okay, number one, the Shoe Station strategy is working exceptionally well and surprisingly across many different kinds of markets. Two, accelerating the conversions is a disciplined financial move with a clear, quick payback. Three, their debt-free balance sheet is a massive advantage right now, letting them invest while others might be pulling back. 4, the consistent outperformance of Shoe Station gives them a clear path back to company-wide comp growth, targeting Q3 '26 and driving future profits.
And just one more time for clarity, this was all based on their earnings call information. It is not financial advice.
Absolutely essential to remember that.
Okay, so here's a final thought to leave you with. If Shoe Station really is working this well in such diverse, lower-income, non-traditional markets already, could its total addressable market be fundamentally bigger and broader than anyone, maybe even the company itself initially thought? And if that's true, how does that potentially change the entire long-term growth story, the speed of this transformation, and the ultimate profit potential for this company? Could it be significantly more than even their newly raised ambitions suggest?
That's exactly what those urban tests in 2026 are designed to help answer. If they get a yes there, the implications could be huge for their long-term trajectory.
Indeed. A fascinating strategic pivot to watch. Thanks for joining us for the deep dive.
Catch you on the next one.